and welcome to this online mentoring session of cost accounting and financial management. Today we are having two interesting topics. One is the budget and budgetary control, and from financial management we are having receivable management, which is basically part of the working capital management. And these two topics we will be discussing today. Certain aspect of these two topics basically we will be discussing today. And while discussing these two topics, we will discuss regarding various aspects of budget, like what is the definition of budget, what is budgetary control, what are the different kind of budget which are available, and there are certain numerical also we'll discuss. One numerical related to production budget and another numerical related to flexible budget. In the receivable management part, basically, as you know, the receivable basically means that how much money we are going to collect from the receivable people, means debtors in other terms. Though now we are not using the terms debtor as such, and various factors are there which will determine that if we extend the credit terms, means if we give easy credit terms to the people to repay the money, whether that is going to benefit us or not going to benefit us. There are certain advantage what we are going to get by extending the credit terms, let's say from 30 days to 45 days or to 65 days. Like for an example, sale will increase, but at the same time, bad debt, there are chances that bad debt will increase, the administrative cost, the collection cost will increase, and moreover, the opportunity cost also will be there for the capital which will be blocked for a certain period of time. So we need to make a comparative analysis between the two to decide that what should be the decision. And similarly, we can take the service of the factoring, and we can also find out whether the factoring service is going to benefit to us or not. So this is the way basically we can find out the advantages and disadvantages of extending the credit terms as well as factoring. And budget from practical perspective also, as you know that preparation of budget is an integral part of any organization. And probably the controlling system starts with budget, and that's why we call it budgetary control. So that whatever the control mechanism we can exercise through the system of budgeting, that's basically wish to indicate. And today with me, my colleague CS Sanjit Sharma is here, and we will try to answer whatever the queries will come to us on your behalf, or whatever the query will come in your mind. We'll try to clear it in this session itself. Obviously, mail is there, telephone is there, and whenever you like to ask any question, you can always call us or mail it to us. And let's start today's session, Sanjit. He will carry you through. Obviously, I will come in between. Can I go to the presentation, please? There are certain what I will say disclaimer which is given. Nothing to do with the council of the institute. Basically, it is the responsibility of the faculty members who was there in the screen and who is speaking to you right now. Then there are certain important notes. There are LMS, Learning Management System of the students, like the knowledge portal and everything, where it is available, how we can get it. That is given here. And studentlms.ici.org is probably the site where you can find all this material. It is obviously the free access which is given to all the students. I think you are very much aware about all these facts right now. So we'll start with budgetary control. There are certain study steps. Obviously, these steps are normal and can be applicable to any of the subject as such. Like planning for this particular subject, that how you are going to do it, what is the plan, what is the timeline you are going to frame, what are the chapters, what are the numerical sources you are going to use, and then implementing that particular study plan, and then reviewing the progress. Reviewing the progress not only at the end but also in between while going through your preparation, so that if there is any adjustment required or anything which you feel that needs to be studied more or less, that you can adjust. And self-assessment through different kind of test, mock test paper, etc., is going to be very, very essential. How you can plan for the study? You can get with yourself aware about the content of the syllabus, the exact content of the syllabus, and very frankly speaking, there are no changes in the syllabus because there are rumors in the market. Always there are that syllabus is going to be changed like that. At present, there is nothing for you people, so you just concentrate on the existing syllabus itself. Then preparation of the plan for each topic, then estimating the total time required, and then you can prepare a written schedule, which you know as timetable basically for each and every chapter as such. In the implementation part, what you can do, you can start preparing as per the schedule, whatever schedule you have prepared, and try to stick with the schedule, because more flexibility you will give to your schedule, and it will be very difficult for you to give a revision time. Particularly if you have kept 10 days or 15 days for the revision of the material, revision of your preparation, you will not be able to get that particular time. Then covering the theoretical aspect and numerical aspect both, so importance should be given in studying the conceptual part of the study material, which will clear you the concept. At the same time, it will help your theoretical part. Then build your concept, already I told you in the previous part, and then application part of it. Application as if whatever the concept you are studying, you are applying in the numerical question. Make your own summary and notes, which will be very useful while revision also. And when you will be writing, it will stick to your mind. It will put in your mind a place which probably you can remember at the time of examination. When you will be at difficult stage, if you just remember what I have noted in my summary notes or notebook, it will really come in just front of you, and you will be able to refer that. Effective studying is, first of all, quiet and disturbed environment is required. So you may find a study room, a place where there is no disturbance. You can keep all materials. You should try to keep the material in a way which is probably sound free, and you should keep the material in a very systematic way so that you can get it whatever you want. But if you are in thick of things, if you're studying too much, then probably your material will be disturbed. So that's a good sign also sometime. And if you're not studying and your material is disturbed, that's probably the worst sign you can ever have. Distraction has to be limited. Particularly, you have to keep yourself away from the social media, the Facebook, the Twitter, the various kind of videos, chatting, WhatsApp, whatever it may be. Study according to the timetable, whatever you have planned for, and go each and every chapter carefully. And note, already we have told you earlier. And while doing the numerical, you will also discover certain things. Like, for an example, you are doing a question on marginal costing. Some people do what? They calculate contribution and PV ratio, whatever may be the requirement of the question. And they find it very easy in that way. So everybody will be different. Everybody is having their own technique, and that will be developed. So you discover the technique, whatever is best suitable for you, and accordingly you can go for. And you can organize, you can keep your notes ready for your final revision. Progress, you have to check. You have to check through different test paper, different mock test paper, or old test paper, RTPs, whatever the material is given to you. And whenever you will be reviewing the progress, whenever you find that a particular chapter requires more time, you should be able to devote more time on that. So you should be more flexible in those aspects. This is self-evaluation and assessment. Various query questions, particularly the numerical questions, you have to solve yourself. And whenever the solution you will get, then accordingly you go through the questions and then try to find out that whether you have done it correctly or not. Previous year's question, which will give an indication that what type of questions comes, and if you have prepared and you have not done the previous year question, it is very essential for you to do it, so that you can face with the similar type of question which can be expected at the time of examination. RTP, which is provided by the Board of Studies of the Institute, you should go through and take part also in the mock test paper organized by various branches. Now, Sanjit, you can start off with the budget and budgetary control, and I will sneak through whenever I feel.
Before starting the budget and budgetary control chapter, we can say the topic of the budget and budgetary control. First, we need to understand what is the meaning of budget. Budget is a monetary and it may be or may not be. It is a monetary or and quantitative expression of a business plan and policies to be persuaded in the future period. So what is the budget? It can be correlated with the practical example. Suppose you have some objective, it may be financial objective or something else. Suppose you have an objective to achieve 100 marks in some paper. Then what you will do? You will make a plan, and to achieve this plan, you have to quantify your plan into the measurable terms. So quantifying the objective into the measurable terms is called budget in financial terms. So a budget is a monetary or and quantitative expression of a business plan and policies to be persuaded in the future period of time. That is, budget is prepared for the future period of time. In other terms, all budget is used for preparing budget and other procedures for planning, coordination, and control of the business enterprise. So, budget is not only used to achieve the objectives of the business, but also for coordinations among the different departments and control of the business enterprise. So, budget is used as a control tool to control the business as well. Definition of the budget, according to the CIMA, Chartered Institute of Management Accountants, London, it defines budget as a budget is a financial and or quantitative statement prepared prior to a definite time period. That means prior to a definite time period. That means budget is prepared at the initial stage. That means at the inception of the financial year or whatever may be the time period. So it is a prior document before going into the actual happenings of the policy to persuade during the period for the purpose of attaining given objective. In other words, Crown and Howard, it has defined the budget as a budget is a predetermined statement of management policy during a given period which provides standard for comparison with results to be actually achieved. That means budget is also used as a yardstick to measure the progress and to compare with the actual achieved goals. Before moving towards the budget, how budget is prepared, it is very essential to know what are the essential elements of budget. We have charted out here the few examples of essentials of budget. That means it is prepared in advance. As I have told you earlier, that the budget is prepared beforehand. Before going the actual things happen, it is prepared beforehand. So it is prior requirement of doing the actual things. So it is prepared in advance for the future plan of actions. It relates to future periods and is based on the objective to be achieved. That means whatever be the your business objective, it has to be achieved, or we can say the objective is broken down into the measurable quantitative and qualitative factors. It is a statement expressed in monetary and or physical units prepared for the implementation of policy formulated by the management. That means to prepare a budget, you need to express your budget in monetary terms and or that means it may or it may not be in physical units. If it is expressed in both terms, that means in terms of money or in terms of physical units, then it will give a comprehensive view to the viewers of the budget, and it will be very helpful for the management to quantify or to measure the actual performance of the budget. The characteristics of budget: a budget is concerned for a definite future period. That means it is to prepare budget, we need to define the period. For example, we are in the financial year 2016 and 17, and if today I am going to prepare a budget, then I have to prepare budget from today, that means 17th of August 2016 to for the future period. It may ended on 31st of March 2017. So budget is concerned for a definite future period time. A budget is a written document. It is a written document because it is documented and it is presented as a policy document to the various departments, so that departments can comply with the policy, or we can say the budget. A budget is a detailed plan of all the economic activities of a business. According to the budgets, all the activities are carried out. All the departments of the business units cooperate for the preparation of a business budget. In case of bottom-up approach of the budget development, suppose budget is prepared for a company or a organization. In case of participative budget, the managers or supervisors who works at the bottom of the hierarchy, management hierarchy, provides input to the top level management to what is the requirement, and on the basis of these inputs to the top management, budget is prepared. So it requires cooperation for the preparation of a business budget, and cooperation is required from the various departments. Budget is a mean to achieve business, and it is not an end in itself. That means merely preparing a budget is not an end, because budget has to be implemented to achieve the objective. So budget is only a tool. Budget is only a way to achieve the objective of the business. Budget needs to be updated, corrected, and controlled every time. That means once the budget is prepared, it cannot be termed as fixed. It may be updated regularly based on the changing economic scenario. Suppose on the basis of sales estimation at the inception of the period, the sales manager has anticipated that for the coming financial year, it will achieve 1 lakh units of a good, but after there is certain change in the economic environment, the demand becomes 80,000. So the budget has to be updated or corrected according to the recent changes in the economic activities, and budget has to be prepared on the basis of 80,000 units, because the economic environment that was there at the time of inception of the period has changed, and now the demand has been reduced from 1 lakh units to 80,000 units. So a budget once prepared cannot be termed as fixed. It should be updated from time to time if required. Budget helps in planning, coordination, and control. It has been explained earlier also. Different types of budgets are prepared by industries according to business requirements. On the requirement of the business, budgets can be prepared according to the need of the organization. Suppose a manufacturing industry may require budgets for direct material. It may require budget for direct labor hours. It may require budget for number of sales unit to be sold, and capital expenditure budget, case budget. That means it depends on the requirement of the organization. Whatever be the budget, because budget is a part of the management information system. Whatever the information management wants, it can extract in the form of budget. So budget is a helping tool for the management to know what exactly the action plans should be. So budget are prepared by the industry according to the business requirements. So if anybody says that budget is fixed, so I will say no, it is not fixed. Budget is flexible. Budget is always flexible. It has to be updated. Now, meaning of budgetary control is it has been discussed in earlier slide that budget helps in planning, coordination, and control. What does it mean by control? So we will when the control comes into the picture and the control is done with the help of budget, then the the name changed from budget to budgetary control, because the budget functions as control tool. So now it is termed as budgetary control. Budgetary control is the establishment of budget relating to the responsibility of executive of a policy and the continuous comparison of the actual with the budgeted results, either to secure by individual action of the objective of the policy or to provide a basis for its revision. Now, I will give you an example how budget helps in control. As we have discussed in earlier slide that budget is prepared according to the requirement of the industry. Now see how the requirement can be controlled with the help of budget. Suppose in a manufacturing organization, the manufacturer needs to prepare direct material budget. That means how much quantity has to be used in the production and how it can be controlled. Now see, for the direct material requirement, what are required, you probably have learned in the standard costing that in direct material we need to prepare price variance. So in direct material we require two components: the price of the material that has to be paid by the organization to the supplier, and the quantity. It means how much quantity is required to produce the expected or estimated sales demand, to mitigate the sales demand. Now, how budget is going to help and how budget is going to control, we can see with the help of this example. The price is determined by the marketing staffs or marketing manager. And in the market, if negotiation is done in very efficient manner, then for example, for say 1 kilogram or per unit of direct material can be obtained at the rate of rupees 100 per unit or per kilogram, whatever be the unit you may choose. And the marketing, the purchase department here, the marketing is not involved here, the purchasing department. The purchasing manager or the purchasing staffs has obtained goods for rupees 110. So we can fix responsibility. We can compare the actual price paid with the budgeted price. So we can see how effectively, how efficiently the purchase department staffs and the purchase department personnel has performed, how efficiently they have performed their duty towards the organization. So this is the control mechanism, this is the control tool to control the price of the direct material, so that the purchase department cannot purchase the goods in their own way. It has to be purchased from the objective of the organization. And so it is a control tool. How to control, we can compare this, and the price can be controlled. Now, in the quantity aspect, suppose the production manager has estimated that to produce 1 lakh unit of final output, 2 lakh kilogram of raw material is required. But in the actual happening, after the production, we can see that it has used 2,50,000 kilogram of raw material. So the manager can compare, when the budget has been prepared, it was only 2 lakh kilogram, and in actual it reached to 2,50,000 kilogram. Now the management can ask the the production manager what is the reason behind for over usage of material. So this is the way how the budget helps to control in the functioning and in fixation of the responsibility of the executives of a policy and continuous comparison of the actual with the budgeted results. So I think you may have understand the meaning of budgetary control. Budgetary control involves establishment of budget because you first need to establish a budget. That means what should be the thing. That means what should be. What should be. Continuous comparison of actual with budget for achievement of targets. Now compare what should be with the help of with the actual happening. Revision of budget after considering the changed circumstances. If the circumstances, economic scenario has changed from the date when the budget has been was prepared to the present day, then it has to be revised. Now, if nothing has changed, that means the economic environment is remain constant, and the actual or the budget is there is a big difference between the actual and the standard. Then you have to place the responsibility. Who is responsible for the failure to achieve the budgeted targets? So these are the budgetary control involvement in all these things. Now, objective of budgetary control. What are the objectives of budgetary control? To ensure planning for future by setting up various budgets. The requirement and expected performance at enterprise are anticipated. It is the objective of budgetary control to coordinate the activities of different departments. It operates various cost centers and departments with efficiency. Elimination of waste and increase of profitability. To anticipate capital expenditure for future. Correction of deviations from established standards. Fixation of responsibility of various individuals in the organization. So these are the objectives of budgetary control. There are some advantages of budget and budgetary control. We can understand it one by one. The budgetary control increases the efficiency of the organization. It increases the efficiency of the organizations and the departmental heads, because when the organization or the department know that their working or their way of working is measured against some standard or some budget, so they work very efficiently to achieve the set target. Budget is a powerful instrument for controlling expenditure. Budgetary control provides a yardstick for measuring and evaluating the performance of individuals and their departments. It reveals the deviations from the budgeted figures after making a comparison with actual figures. It creates suitable conditions for the implementation of standard costing. Actually, budget is a pre-requirement for standard costing. With the help of budget, standard costing method comes into the picture, because the budget is the basis on the basis of which standards are set. Effective utilization of various resources like men, material, machinery, and money. Budgetary control inculcates the feeling of cost consciousness among workers. It helps the principle of management by exceptions to applied. Obviously, there are some limitations of budgetary control systems. All are based on the estimates. That means everything has to be done by the making estimations. So there is chances of error, because we know that estimates can never be the actual. So there is always a chances of risk of estimation. The time factor, That means budget is prepared for the future period, so we don't know what will happen in the future. So time factors comes into the considerations. To implement the budgetary control very effectively, the cooperation is required among the various departments. So cooperation is required. It is expensive exercise because it takes times, it takes uh, various resources of the organization. It is not a substitute for management because it is only a tool that helps the management in controlling the organization to achieve the objectives. Budgetary control is a rigid document. It is sometimes criticized by some person, some writers, that it is only a rigid document. Now we will see the classification of budgets and types of budget. Budgets can be classified as we have discussed earlier, that budget is prepared according to the requirement of the organization. So is the requirement, budget is prepared according to the requirement. So if budget is prepared for the time, if we are going to prepare budget for the time, so budget can be prepared for long term and for short term, and it can be prepared for current budgets. What is the meaning of long term budget, short term budget, or current budget? We will discuss in the later slides. On the basis of function, budgets can be classified as operating budgets. Under the operating budget, the direct material budget, purchase budget, production budget, all these things comes. Thereafter, the financial budget and master budget. And the classification on the basis of flexibility, the fixed budget and flexible budget. The long-term budget on the basis of time, the budgets are prepared to depict the long-term planning of the business. Long-term budget is prepared for a period of say 3 to 10 years. These budgets are useful for the industries where gestation period is long. For example, machinery, electricity, etc. Short-term budget, these budgets are generally for 1 or 2 years and are in the form of monetary terms. It may be in quantitative terms also. The consumers goods industries like sugar, cotton, and textile use short-term budgets. Current budgets is a budget which is created or which is established for use over a short period of time and is related to current conditions. Current budgets may be prepared for say for the month or for a week also. On the basis of functions, the budgets may be sales budget. It represents the physical quantities and value of the total sales. That it answers the questions: what should be sold, when it should be sold, where it should be sold, and how much it should be sold. Production budget. Production budget is normally stated in units of output. Production should be carefully coordinated with the sales budget. While preparing the budget, it is it can be said that sales budget is the starting point. Before before preparing any other budget, sales budget is prepared because sales budget is the starting point. After knowing the sales estimate or the sales budget, the production budget is prepared. To prepare the production budget, we require how much we are going to sell. That means estimated sales demand is required. With this estimated sales figure, we adjust for opening inventory or closing inventory. Thereafter, we know how much quantity will be produced. This is called production budget. When we multiply the quantity of the production with the value, then it can be expressed in monetary terms. Thereafter, plant utilization budget. On the basis of production, we can measure how much capacity of the plant will be utilized. Direct material usage budget, that means on the basis of production budget, we can say we can determine how much material or raw material will be used for the production. So on the basis of production budget, direct material usage budget is also prepared. To prepare direct material usage budget, we adjust the opening inventory of the raw material and the closing inventory of the raw material. Thereafter, we prepare purchase budget to how much quantity we require to purchase to execute the production. So the purchase budget says how much quantity we require to purchase from the outside. To prepare the purchase budget, we require how much quantity of the goods is going to be produced, and we just adjust the opening and closing stock. Thereafter, the personal or labor cost budget. As per the requirement of the organization, the capital expenditure budget is prepared. Capital expenditure budget represents the planned outlay on fixed assets like land, building, plant, and machinery. For example, if an organization is thinking of expansion, so it will prepare how much expenditure will going to it will going to spend on this expansion plan. So it is the more nothing but the capital expenditure budget, because we are budgeting for the capital expenditure that will happen in the future period. The cash budget, that means how much liquidity is required for the organization. And the master budget, when all the necessary functional budgets have been prepared, the budget officer will prepare the master budget, which may consist of budgeted profits and loss account and budgeted balance sheet. These are in fact the budgeted summary. The master budget is a principal budget, and it consists of all other budgets, whatever the budgets we have discussed in earlier slides. Master budget, it takes into account the revenue side. On the revenue side, it takes sales budget. On the expenditure side, it takes purchase budget, production budget, and all the components of the cost. And thereafter, it will also provide the how much budgeted profit will be. On the basis of flexibility, the budgets are fixed budget and flexible budget. Master budget is on the basis of function only. Now we will understand what are the what is the differences between the flexible budget and fixed budget. On the basis of rigidity, as the name suggests, fixed budget remains the same irrespective of changed situations. It remains inflexible even if the volume of business is changed. The flexible budget is recast to suit the changed circumstances. Suitable adjustments are made if situations so demands. On the basis of conditions, fixed budget assumes that the conditions will remain constant, while the flexible budget is updated. Actually, flexible budget is nothing but the updated version of the fixed budget. The cost classification, on the basis of cost classification, in fixed budgets, costs are not classified according to their nature because everything is fixed. In flexible budget, the costs are studied as per their nature. So to prepare flexible budget, we need to classify the cost, whether it is fixed, whether it is variable, or whether it is semi-variable in nature. The changes in volume, if the level of activities changes, then budgeted and actual results cannot be compared because the change is basis. So the fixed budget cannot be used to compare the actual result because fixed budget is not updated according to the environment. So fixed budget cannot be used to compare the actual budget or actual performance of the organization. Whereas the flexible budget is adjusted according to the actual happening in the organization. So flexible budget is used to compare the budgeted and actual figures. Forecasting of accurate result is difficult in case of fixed budget, but in case of flexible budget, the impact of expenses on operations can be exactly forecasted, or you can say we can forecast on the basis of flexible budget. The cost ascertainment under changed circumstances, cost cannot be ascertained, but under a flexible budget, the cost can easily be ascertained under different level of activity, because in flexible budget we classify the cost elements into the fixed, flexible, and semi-variable. Now we will understand the flexible budget with the help of one illustration. This illustration has been taken from the practice manual. You may also find it in the practice manual. Messrs NNSG Limited, specialized in manufacturing of piston rings for motor vehicle. It has prepared budget for 8,000 units per annum. So it has prepared budget for 8,000 units per annum. And it has also budgeted the cost for the budget quantity. It has budgeted that the total cost will require is 21,64,400. And the bifurcation of the cost is also given. The fixed cost, that is mainly consists of manufacturing cost, is 2,28,000, and the others are variable cost. The power cost is 18,000. That means this 18,000 is given for 8,000 units. That means the per unit you have to find out. So first, in case of variable cost, we will have to find out the per unit cost. This is rupees 2.25 per unit. Repairs, etc. It is 16,000 for 8,000 units. You have to find out how much for 1 unit. So it is rupees 2 per unit. Other variable cost is rupees 6,400 for 8,000 units. 0.84 per unit. And the direct material cost is 6,16,000 for 8,000 units. It is 77 per unit. And the direct labor cost is rupees 12,80,000 for 8,000 units. It is 160 per unit. Now, with the help of this figure, actually, when the management has prepared this budget for 8,000 units, now we can say this is the fixed budget. What the management has fixed, that means management has fixed that if 8,000 units is prepared, 8,000 units is manufactured, then this should be the cost that management will, the organization will have to incur. Now, considering the possible impact on sales turnover by the market trends, that is the economic environment, the company decides to prepare flexible budget with a production target of 4,000 and 6,000 units. That means updating the demand of the product. Now it is going to prepare, if the demand comes down to 4,000, then what should be the cost? And if the demand again comes down to 6,000 units, then what should be the cost? So on behalf of the company, you are required to prepare a flexible budget for production level 8, 50% and 75%. That means 8,000 is 100%, and you have to prepare for budget of 50% of 8,000. That means 4,000 units, and 75,000 of 8,000. That means 6,000 units. The further information is given that assuming the selling price per unit is maintained at rupees 400, as at present indicate the effect on net profit. Administration, selling and distribution overheads continues to at rupees 72,000. With the help of these information, we have to prepare a flexible budget. From this fixed budget, we will prepare the flexible budget. Now you see, this column is the fixed budget for 8,000 units. Now we will take all the changes, all the informations given in the questions to prepare the flexible budget. So for the 50% capacity, the production unit will be 4,000, and at 75% production capacity, the production units will be 6,000. Now we can see that when, as we know, as it has been given in the information, that the selling price will remain unchanged. So we will just multiply the production units with the sales price. It comes to 16 lakh, it comes to 24 lakh. Now direct material, how it will be calculated. In the previous slide, I have calculated per unit cost for power, repairs, other variable cost, direct material and direct labor. Using this per unit information, we can calculate the variable cost for flexible budget. Direct material per unit cost was 77. What we require at 4,000 units multiplied by 77, it will come to 3,08,000. Similarly, for 6,000 units, we multiplied 6,000 multiplied by the direct material cost per unit. It comes to 4,62,000. Similarly, for direct labor, we have multiplied the per unit cost, that is 160 to 4,000. It comes to 6,40,000. At 6,000 level, 9,60,000. Similarly, for power, we have multiplied per unit cost with the activity level, that is the 4,000 and 6,000. At 4,000, it comes to 9,000. At 6,000, it comes to 13,500. One thing you must remember here, that in this cost structure, no semi-variable cost has been given, so you may not require to find out the semi-variable cost component separately. Otherwise, it has to be calculated. Similarly, for repairs, we have calculated. By this, we have calculated the total variable cost. For 4,000 units, it comes to 9,68,200. For 6,000 units, it comes to 14,52,300. In the question, it has been given that the fixed cost, that is the manufacturing fixed cost, is 2,28,000. For a certain range of the production, the fixed cost remains constant. So manufacturing cost remains constant irrespective of the level of the activity. So manufacturing cost is 2,28,000 for each level. Similarly, in the question, it is already given that administration, selling and distribution overheads continues at 72,000. So it will not change. So irrespective of activity of, it will 72,000. Total fixed cost comes to 3 lakh, and after adding variable cost and fixed cost, the total cost comes for 4,000 activity level, it comes to 12,68,200. For 6,000 activity level, it comes to 17,52,300. And we know the sales figure. We deduct the total cost from the sales figure to know what should be the budgeted profit. So at 4,000 unit, the budgeted profit will be 3,31,800. At 6,000 production level, the budgeted profit will be 6,47,700. Now we will understand the preparation of production budget, how production budget is prepared. In this is also from the practice manual. You can refer the practice manual to know how it is calculated. In the question, it is given that AK Limited produces and sells a single product. Sales budget for calendar year 2013 by quarter is as under. For first quarter, the number of units to be sold is 18,000. For second, 22,000. For third quarter, 25,000. And for fourth quarter, the sales demand is 27,000. The year is actually, this question is very typical type of question which comes in the examinations also. So you need to understand it very carefully. The year is expected to open with an inventory of 6,000 units. That means for the first quarter, there will be an opening stock of 6,000 units of finished product, and close with inventory of 8,000 units. That means for the fourth quarter, you have to maintain the opening closing stock of 8,000 units. Production is customarily scheduled to provide 70% of current quarter's sales demand plus 30% of the following quarter demand. That means the production pattern is like that. If in the first quarter the sales demand is for 18,000, then 70% of 18,000 is prepared plus the 30% of second quarter's demand, that is the 30% of 22,000 will also be produced in the first quarter itself. So these are the pattern of the production. In the question, the budgeted selling price per unit is also given, which is rupees 40, and the standard cost details is also given. The fixed overhead requires 2 hours 30 minutes, and the fixed overhead rate is rupees 2 per hour based on the budgeted production volume of 1,10,000. Here, the production volume is given 1,10,000, and the fixed overhead rate is given on the basis of per hour. So you have to find out the fixed cost. How you can find out the fixed cost? It is very simple. The production volume is given 1,10,000, and you know to produce 1 unit, 2.5 hours required. So to produce 1,10,000, the total hours required is 2,75,000 hours, and the rate is given, it is rupees 2 per hour. British fixed cost is 5,50,000. So this is the way you have to remember what is to be, what data you need to calculate. With the help of this information, you have to prepare quarterly production budget for the year. So sales demand, it is taken from the question itself. For the first quarter, it was 18,000. For second quarter, 22,000, 25,000 for the third quarter, and 27,000 for the fourth quarter. In the question, it was given that the year is expected to open with an inventory of 6,000 units. That means for the first quarter, there will be an opening stock of 6,000. Now, following the production pattern of the organization, the organization said in the question, it was mentioned that the organization schedule, the production schedule is like that to provide 70% of the current year's sales demand and 30% of the following quarter demand. 70% of 18,000 is 12,600, and 30% of the 22,000 is 6,600. So total production is 19,200, and the sales demand is 18,000. So there is a closing stock of 7,200. This closing stock becomes the opening stock for the second quarter. In the second quarter, following the same production schedule, the 30% of 22,000 is 15,400, and 30% of the 25,000 is 7,500. So total production in the second quarter is 22,900. After deducting the sales demand, the closing stock will be 8,100. This 8,100 will be the opening stock for the third quarter. In the third quarter also you have to follow the pattern of the production. That it means 70% of the 25,000, 17,500, and 30% of the 27,000, 8,100. Total production is 25,600 including opening stock, and after deducting the sales unit, the closing stock comes to 8,700. Now be careful here. In the question it was mentioned that the year will close with inventory of 8,000 units. That means at the fourth quarter, the company has to maintain a closing stock of 8,000. So first we will have to fill this column, 8,000. This will becomes your opening stock for the fourth quarter. That means now you have filled up two parts, opening stock and closing stock. Following the pattern, the current year demand 70% you produced, and this will be the balancing figure. So for this you are not following the pattern until unless the next quarter's sales demand is given in the question. Otherwise you will have to find out with the help of balancing figure. So this will be the balancing figure. So this is how the production budget for the year is prepared. Now we will move towards the financial management part, and today's topic is receivable management.
Now, just to sum up the budget, there can be different other kinds of budget as well beside the production budget and the flexible budget. There can be sales budget also. There can be a budget where there can be mixture of different things. And here I believe, I think my colleague will agree with me, the language is going to be very, very crucial, particularly of the numerical questions. What language they have written. Because sometimes the closing stock will be given of some quarter, some month, like that. And so some of the conditions will be given in the question, and other condition you have to follow. Similarly, the production is given, you may have to prepare the production cost budget. Or maybe production is given, you have to prepare the sales budget. Sales is given, you have to prepare the production budget. But these are similar to each other. Only if you practice and read the questions very carefully, you will be able to understand. In case of questions related to flexible budget, I must tell it to you, I think my colleague has also informed that here in this question, these are the variable cost which is given straight away. One thing you remember, there can be variable cost, there can be fixed cost, there can be semi-variable cost as well. And it is very essential for us to classify the semi-variable cost into the variable part and the fixed part. And the variable cost treatment will be like variable cost, and fixed part treatment will be like fixed cost. And variable cost, all variable cost, or part of variable cost from semi-variable will be in unit. And when the unit is going to change, the total cost is going to change. Where the fixed cost, either the direct fixed cost which is already given, or the fixed cost part which you have derived from the semi-variable cost or semi-fixed cost, is going to be the cost which is going to be total cost. Means for the total unit of production, like in this case 8,000 unit, if it is 2,28,000 manufacturing fixed overhead, then the same is going to be applicable with whatever may be the unit we are producing. So these are some of the classification of cost, like variable, like fixed and semi-variable. The same type of classification, the application of same classification, what you see in marginal costing, here also the same thing you will see. So these are the principles you need to keep in mind while solving any of on this type of questions. I think if there is any question answer, then we can probably go for that for the costing part. Otherwise, we can go for the receivable management part. Let's see whether you have given any question or not. Mohit has asked whether the institute is providing any summary note or not. Mr. Mohit, we are not providing any summary note as such, but we are having practice manual where initially in the very first page, we have given all the basic concept in a summary format. And then the questions come. So if you want to have a summary of that, I think that is going to be very, very useful for you. Any other question, Mr. Mohit? Or anybody else want to ask any question, particularly from the cost part, whatever we have discussed? We're just waiting for you so that if there is anything, you can type it out and send it to us immediately. Otherwise, we will go for the receivable management part. You can start with the receivable. Now, in case of receivable management, first of all, the meaning of receivable management has to be very, very clear to all of you. Basically, whatever the sale we are making, which is on credit, and the people or the customers who are supposed to pay the money to us after some period of time, means we have given the goods to them, but we have not received the money. We have sold the material or the product on credit, and we need to collect the money from them, or they need to give the money. So what happened in this kind of things, the risk is involved because they may or they may not pay the money to us. And one more thing, what is going to be there, we are talking about the future perspective, because in the future only the credit sale is going to be converted into the cash sale. Why the companies give on credit? Sometimes we feel that why not it should be given on the basis of cash. Obviously, first of all, there is a cutthroat competition among the various companies of the same industry. If you talk about paint industry, all paint industry. If you talk about cement industry, then all cement industry. And they need to have the credit terms with all the supplier, all the buyers, so that they are having good number of customers with them. So competition is probably the one major things for which the companies grant the credit. Then the company's bargaining power, particularly the bargaining power of the people who are purchasing from them, and the requirement of the buyer, because buyer also will be maybe constructing something, like for an example cement. They will be constructing a building, so they will take credit of cement from some company, and then when they will be able to sell that flats, they will be able to realize the cash. It's a marketing tool. So marketing tool, it will help us, particularly if you see for the domestic goods also, you want to purchase a fridge. If 3 months credit is given, that will help us, or 6 month credit is given, that will help us. It will build a relationship with the dealers, long-term relationship, particularly continuously if you are giving the credit and you are getting the payment also. And moreover, it's an industry practice. In fact, cash sale concept is almost not existent in case of industry. It's more of the credit sale which we talk about. And whenever we are talking about the credit sale, automatically what will happen, the concept of receivable management is going to come. And since the major of the industries follow the receivable management policy, the credit policies, then receivable management becomes very important. Now, what is the meaning of the receivable management? Receivable management is basically how we can manage the receivable, how we can manage the credit, how we can collect the maximum from the sale, credit sale, what we are doing. At the same time, we can increase the sale. So on one hand, we want to increase our sales so that our revenue is going up. At the same time, we need to monitor, we want to evaluate, we want to prepare, we want to monitor the system in such a way that the defaulters, the number of defaulters or the amount of defaulters is less. Or at the same time, the opportunity cost of the money which is blocked in the receivable is not that much. So it's basically a balancing act which we do between the sales and different kind of expenditure what we have. Now the meaning of credit policy basically means what is the amounts what we are putting as an investment into the receivable, And it will depend on mainly two things. One is the credit terms, that basically is the credit policy, and second is going to be the volume of the credit sales. And also, how much sale is going to be your credit sale. Means if you are 100% credit sale, then obviously the volume is going to be very, very high. And when you are talking about the collection period, mind you, if the collection period is, let's say, 1 lakh rupees, collection period is, let's say, 50 days, and if the credit is 1 lakh per day, so mind you, it is 50 multiplied by the 50, 1 lakh, that is 50 lakh rupees is going to be your credit. So ultimately what happens, the credit number of days and the amount of credit per day, this basically, becomes the investment in the receivables. And the cost part of that is going to be very, very crucial for us, because sales part may not be that much crucial, because in the sales the profit element is already covered. So cost of sales, this part is basically the net investment what has gone from our pocket, and we need to calculate the opportunity cost of this and to recover in the credit policy. There can be different kind of goals in the credit policy. One, the first and the most important is to maximize the sales, because we believe that other kind of expenditure still we can control, but sales is not in our hand. Sale will depend whether our customers, our creditors, our people, our customers are purchasing the product from us or not. So maximizing the sales is basically the major emphasis what we give on while fixing the credit policy. And when you are tinkering on with that, when you are increasing, let's say, from 30 to 45 to 60 days, our basic objective, along with the increase of this number of days, that the incremental profit should be existent in all levels. And till the time that incremental profit is existent, probably will not mind increasing the credit policy. But the moment this incremental profit will become the incremental loss, there we have to put a full stop and we have to come back to the situation. So we have to be very, very careful in extending the credit policy. At the same time, the conservative credit policy also may not be good, because that may hamper the maximization of the sales as well as maximization of the profit. And generally what happens, there are different kind of cost and different kind of opportunity cost which is involved here. First of all, the production and the selling cost which is going to be involved whenever there is a sale, the administration cost, particularly whatever the additional things we are giving, and whenever you will be extending the credit terms, the number of defaulter is going to increase. And whenever the number of defaulter is going to increase, the bad debt part is going to be increased. So mind you, this is a very important loss, and these are the different costs which is going to be increased. So this is basically going to be increased, and this is the loss which is again going to increase. Second, we will lose some opportunity cost of contribution, because opportunity cost is particularly when you will be investing the money, the cost part of that will be blocked for a longer period of time. And then administration of that, chasing. Now a lot of banks are having nowadays chasing department. So credit chase department or credit collection department, they will talk, they will send a letter, they will follow up, even they will go and visit the customers. So these are the costs basically which is involved in the credit policy. Now if you see here, we need to take a very balanced effect of this. If you see the graphs here, the credit policy, whenever you are making a very stringent credit policy, what will happen? Your sales is going to be less. Your opportunity, your cost of administration and other things is going to be very, very less. But at the same time, your sales amount may not be that much high. And whenever your credit policy is very, very loose, then what will happen? Your cost of administration and the loss, bad debt loss, is going to be very, very high. So we need to make a system which is going to be optimal for us and which is going to have a balance of all this expenditure as well as the benefit what we are going to get. When we want to formulate the credit policy, we can have different kind of standard. We can have different kind of policies. Like credit for period can be determined, that what can be the credit period. Cash discount, what percentage of cash discount we can give, particularly to motivate the customers, to motivate the the receivables to pay the money as early as possible. And so basically we'll invite them by putting some additional discount that you pay the money and take this discount. And obviously we need to pay the collection effort also, particularly to collect the money from the customers. Now each of these can be discussed, like for an example, criteria for selecting the customers, that is the credit standard. Obviously long-term relationship, already who is the customer, then it is going to be very easy for you. But whenever you are having a liberal credit standard, it will push sale, but at the same time the bad debt loss is going to increase. And whenever there is a steep credit standard, it will reduce the sale, but it will reduce the collection cost as well as bad debt cost. So you can see there is a positive effect and there is a negative effect. And you need to have a credit standard which is optimum, which is the trade-off between the incremental return and the incremental cost. So how the credit credit granting decision is taken, basically no credit is given when there is no payoff or it is not favorable. You will be granting the credit whenever it is favorable. Then in the favorable also, if you are receiving the payment, then benefit basically is going to be the PV of the future net cash flow. And if you are not receiving the payment, then basically the investment is going to be lost or the cost is going to be lost. And then comparison between these two, this is going to be positive, this is going to be negative. So net payoff you are going to get, that whether you have been benefited or not. Now meaning of credit period, as discussed earlier, is going to be very, very important. We use this kind of statement 2 by 10 net 35. It means very simple. 35 days is the time in which you should be able to give your money back. Means your money should be paid within 35 days. But if you give within 10 days, additional discount of 2% will be given to you. So basically a motivation is given to the customer to pay the money within 10 days. So if anybody pays within these 10 days, so this 2% amount will be paid. So this is basically the meaning of net 30 or net 35 or net 40. Lengthening the credit period, when it will be extended, as already told you, that sales will be increased, debtor will be much more, bad debt will be much more, the administration cost will be much more, and all these things will be less whenever the credit period is shortened. But at the same time, you must understand that sales is also going to be less. Sales, which is the major sources of revenue, if that is less, then obviously the organization is not going to be benefited positively. Cash discount, as already we have discussed, cash discount basically a motivation so that we get prompt payment from the customers. Now factoring, basically what happens, sometimes for the credit management, we take help of a specialized organization who basically known as the factoring organization. They are very, very popular. So basically they are the agencies who are responsible for collecting receivables on behalf of the company. Company basically focuses on other things, but these factoring organizations basically are responsible for that. Evaluation of credit policy is going to be there. So the 5 C's basically it is known as character, capacity, capital, collateral, and condition. This is going to be measured in evaluation. The credit scoring, we can have a credit scoring on that. The discriminant analysis we can have, and then we can have the risk classification scheme. These are the different ways basically the credit evaluation can be done, whether the credit evaluation is going to be correct or not. This is a question. You can see that a firm has a current sale of 2,56,48,750.
The firm has unutilized capacity. That means the firm is having some capacity in hand. The firm has spare capacity. In order to boost its sales, it is considering the relaxation in its credit policy. The proposed term of credit will be 60 days credit against the present policy of 45 days. That means the company is earlier, the company is giving 45 days credit policy, but it is considering to give 60 days instead of 45 days. As a result, the bad debt will increase because the number of days will be increased. So obviously, the chances of bad debt will also increase from 1.5% to 2% of sales. The firm's sales are expected to increase by 10%, but by doing this, the sales will be up by 10%. The variable operating costs are 72% of the sales. The firm's corporate tax rate is 35%, and it is required an after-tax return of 15%. That means the required rate of return by the firm is 15% on its investment. Now the firm has to decide whether it should change its credit period or not.
So if you see the questions critically, you will find, if you compare, that this was 30 days and it has become 45 days. Now what has happened? Bad debt was 1.5%. Now bad debt is 2%. So you can see a increase in the cost. Okay, 45, 45 and 60. And this is 1.5% and this is 2%. Now sales is expected to increase by 10%, means here it is 100%, so here it will become 110%. Then operating costs, which are 72% of the sale, and corporate tax rate is there, and return is also given, after tax return is also given. So opportunity cost rate is 15%. So whenever you will be extending the credit terms from 45 days to 60 days, more amount of money will be blocked. So your opportunity cost is going to increase. So we can compare now this here. If you see, what was the credit sale earlier? This was the credit sale, 2 crore 56,000 56 lakh 48,750. Now if you multiply it by 110%, then you will get this amount. So credit sale was this much, and it has increased in the circumstances. Now total cost other than the bad debt, it was 72% of the sale. So that basically we have deducted in both the cases 72%. Then the bad debt. Earlier the bad debt was 1.5%. Now the bad debt is 2%. 2% of what? 2% of sales. Please read this language. Sometimes it may be given cost of sales like that. So reading the language is going to be very, very critical. So bad debt we have calculated. So sales minus the cost minus bad debt, what we have got is the PBT, means profit before tax. And then we can reduce the tax also, that is at the rate of 35%. That has come 23 lakh 78,922. And here it is 25 lakh 67,440. So profit after tax, after that we can get, and profit after tax has come 44 lakh 17,997 and 47 lakhs 68,102. So still this stage we can see that there is an increase in the profit. But is it enough? No, it is not enough, because we need to compare another things also, that is the opportunity cost. Though here the margin is significant. Margin is around 3 lakh 50,000. If this margin is, let's say, 1 lakh or 50,000 only, and you are extending the credit terms, then opportunity cost of the receivable will take this profit over. Means your cost will be more than the profit. So how much benefit really you are getting in the incremental profit, it will depend a lot that whether you should go for that or not. Now opportunity cost, how we calculate for the present and for the proposed policy. For the present policy, you can see this is basically the cost of sales. Sales we don't take, because in the sales the profit element is included. So this is the cost of sales we have taken. This is the total cost. Then the collection period, that was 45 days. 360 days normally in a year we take, but if nothing is given and somebody takes 365 days, there is no issue. 15% is basically the cost which is given, after tax return of 15% is given. So that 15% is multiplied, and as per the present policy, the opportunity cost has come 3,46,258. So that has come, and that we have deducted. In case of proposed policy, the 60 days, here it was 45 days and here it is 60 days. And if this amount also increases, then this amount is going to increase much more. Here it is not that significant, here it is not that high. To 2 crore 3 lakh 13,810. So that we have multiplied by 60 days into 15%, it has come 5,07,845. And after reduction, if you see the net profit, it was 40,71,139, and it is increased to 42,6257. So there is an incremental net benefit what we can get.
It can be solved in the by applying incremental approach.
Absolutely. So the approach can be different way. Here the total approach can be taken, or you can only see that what is happening by increasing this by 15 days. How much net this is increasing, how much cost is increasing, how much benefit you are increasing, and then you will compare the both, and you will be able to understand whether actually you should be going for this or not. Another question we can have related to factoring, whether we should be using the services of the factoring or not.
In the question, it is given that a firm has a total sales of 12 lakh and its average collection period is 90 days. The past experience indicates that bad debt losses are 1.5% on sales. The expenditure incurred by the firm in administering receivable collection efforts are 50,000. A factor is prepared to buy the firm's receivables by charging 2% commission. The factor will pay advance on receivable to the firm at an interest rate of 16% per annum. After withholding 10% as reserve, calculate net benefit to the firm. Assume 360 days in a year. In this question, the total sales of the firm is given and the collection period is also given, that is 90 days. And here the company has to make decisions whether it should go for factoring or not. So with the help of this information, the company will decide whether it should go for the factoring.
Now for the factoring, what we can do, first of all, we need to calculate certain things. And first information what you need to calculate is what is the level of receivables. Now here you can see the 12 lakh is given as the sale. This one 12 lakh is your sale and it is given for 90 days. So the receivable, first of all, we can calculate, that is 12 lakh into 90 days divided by 360 days. Sometime what happen, it will say that 50% this many days and 50% this many days. Like this time question has come. So you make it in that way. You can calculate in different way. It's a simple mathematics only. So you can make 60 lakh for this many days plus 6 lakh for this many days. Or you can calculate the average number of days and you can do it. So there are many ways you can do. Second thing, you can calculate out. This is now the level of receivable what you have got. What is the commission you need to pay? 2% is the commission. So what is the amount of commission? You can calculate. What is the reserve? 10% is the reserve. Reserve is basically the amount which is retained. So 30,000 is the reserve. Now this 30,000 as well as commission, these two will be deducted from the amount which is be available for the advance. 6,000 plus 30,000. So 3 lakh minus 36,000. So 2,64,000 is the amount which is available for the advance. Now out of this 2,64,000, there is going to be an interest. Now how this interest is calculated? Let us bifurcate this 2,64,000 into 16%. You just think in that way. Into 16%. Now how many days? 90 days. So this is basically the percentage what we have applied, and this is the number of days. This is basically 1/4. So that has come as 10,560. So from the receivable, we have deducted commission, deducted reserve, and we have deducted the interest. What is left is basically the advances which is to be paid. So now you can see it here, that factoring commission. Now this factoring commission has come. This has come only for the percentage. Now yearly we can calculate this 6,000 only for that period of credit terms. Now if you take it yearly, it has to be 24,000. You can calculate in different way. This is basically for 1 quarter only. 3 months. 90 days means 3 months. So for 1 year, it will be 6,000 into 4. That is 24,000. Or you can calculate in any other way. Then interest charge, that also we have got here only for 90 days. Interest charge 10,560. You make it yearly 42,240. So total cost is going to be 66,240. Now what is the saving? Now cost of administration, which is going to be saved, which is already given in the question. This is basically the collection. It may be given in the percentage also. And bad debt, basically avoided. What is the bad debt we avoided? That is also given in the question. Bad debt losses of 1.5%. So that also has been avoided. That is 18,000. So 68,000 is basically the benefit what we have got, and 1,760 is basically the net benefit. This minus this, this minus this. So this is the net benefit we are going to get from the total factoring. So definitely in these cases, the organization must go for the factoring. So what you need to do, you can calculate this as the main part of the question also, or you can calculate in the working notes. Calculate the receivable, calculate commission, calculate the reserve, calculate the reserve, and then you calculate the amount available for advance. Whenever you will be able to reach the amount available to advance, calculate the interest on that. Mind you, interest will be calculated on that amount, and then if you deduct it, you will be able to get the advances which is to be paid. This is one part of the question basically. If percentage somebody wants to know that what can be the factoring percentage and all this can be calculated. Cost wise percentage, if you anybody want to know. So this is the total cost 66,240, out of which 2,53,440. So percentage wise, that divided by this into 100%, that also can be there. If banks is giving you the let's say grant interest is 15%. If that rate is lower, you will accept that. If factoring rate is lower, you will be accepting factoring. So all those kind of permutation and combination can be given. But basically, we need to understand, we need to ascertain whether taking help from a factor is going to help our organization in minimizing the cost or maximizing the benefit, or neutralizing both, or increasing the net benefit to it. If it is positive, we will accept it. If it is negative, we will not accept it. It is as simple as this. So this is basically the crux of the receivable management, where basically we need to take a decision either with the factoring or without the factoring, that whether credit terms should be extended or should not be extended. If it is extended, then what should be the way it should be extended? And there are different approaches, different ways. Now in this time, in the practice manual, in the April practice manual, myself and my colleague has made it sure that working capital management, the requirement, then this receivable management, all the formats we have made in uniform. So you can take the benefit of that. I think it is hosted on the website also, that how this uniformity has been brought into this chapter. If there is any question, we can take. I don't think there is any question. So that's all from our side in this online mentoring session of cost accounting and financial management. And till next time, goodbye to all of you from myself, Dr. Sengupta, and my esteemed colleague, C.A. Sanjit Sharma. Thank you very much.